Welcome to Chapter 2 of our Exit Planning series. My name is Sean Sebold, President and Founder of Sebold Capital Management. So today on our Chapter 2 here, we're going to talk a little bit about company valuation. What is your company actually worth? Clearly very important in the exit planning process because really that's what we're looking for. What's the value? So let's take a look at some of these metrics that we can talk about. Business valuation, it's the price tag. So it's what someone is willing to pay you for your company. And there are going to be an enormous number of influences on how we come up with that number and what makes the most sense. So clearly financial health is a critical factor. If you're in great financial health as an ongoing concern, that's going to have an impact. Operational metrics also going to have an impact. So what industry you're in, how well you're doing relative to competition, price to, or not price to sales, but when we're talking about turnover ratios and how quickly you're moving inventory, or if you're in a sales organization, or if you're in a service organization, all of those operational metrics are going to influence how that buyer values your company. Strategic position. So what is strategic position? Where do you fit within the marketplace? So we have products that are high value, high price. You've got products that are low value, low price. You could be somewhere in the middle. When it comes to looking at strategic position, that's going to have an impact on what price somebody's willing to pay. If they're a low-cost provider and you're a high-value provider, might not be a whole lot of matches when it comes to that. So the valuation will be influenced by that. Market industry dynamics, yes, that can have an impact. What market you're in, what sector you're in, what's going on in that particular market. Is it high growth? Is it slow growth? Is it consolidating? All those things are going to have an impact, again, on the overall price. Assets. Are you an asset-rich company or are you a service company? Again, those can have an impact on what a willing buyer is going to pay. Synergies. So this is just when you start getting into gray areas of, is there a certain synergistic relationship? Can we cut costs in some merger? Can we change the way that we're doing things in order to get a 1 + 1 = 3 opportunity? So many deals are sold on synergies. Many of those deals don't actually synergy don't come to fruition, but it is an impact on that sale. Cultural fit. East Coast versus West Coast, Midwest versus West Coast. All those kind of cultures have to fit in order for a good transition to happen if you're looking for and keeping personnel from a different organization. What risks are associated? Okay, are there risks in certain industries? Absolutely, there are risks. And just to give some very big examples on risks, Airbnb had risks when it was doing what it was doing. Has regulatory problems with regards to this new business model. New business model always comes with some type of risk as to how it's going to be regulated. Uber, Lyft, are they taxis? Do they have to be regulated? If so, how? So are they employees versus contractors? So risks will have a valuation component to it. Macroeconomic factors. Are we in a low interest rate, high growth area? Are we in a high interest rate, low growth area? Are we running into inflation? We're running into recession. All of those, again, will have an impact on that potential purchase price. What's the company lifestyle or life cycle? Do we have a product life cycle within the company? Is the company going through big growth? Is the company going through maturity? All of those things will also have an impact. What's the business history? That can have an impact. What's the cost to rebuild? So if you said, I can buy this company for X, but I can build it for Y, is the time going to be a factor? So that can also have an impact. And the deal structure. So if I'm going to give you $10 million today and tomorrow you're done, that's going to have a very different viewpoint versus I'm going to give you 40% and 60% in my private equity fund that you'll have 3 to 5 years to get out if, of course, it's in the money. Also will have an impact. So those are some of the influences on valuations, but value to whom? So is it important to the value to you? Is it going to be important to the value to their competitors? So which one's more important? Well, you're only concerned about your valuation, but it has to be a value to somebody else willing to pay for you. So that might be your competition who might want to buy you. might be the industry who says you're worth a lot more because of these issues. And then, of course, you have the unknowns. What happens if there's somebody out there, some company out there that really has a desire for your company and you don't know why, but they're going to value it. So all of those can also have an impact. Okay, so let's get into kind of the nuts and bolts, some of the valuation metrics. We're going to go through these pretty quickly here. So you got price to earnings. PS is price to sales. PV, price to book. EBITDA, which is talked about a lot. Book value, comps. FCF is free cash flow, dividends, what's paid out, and discounted cash flows. So what is price to earnings? So price to earnings is pretty straightforward. That is, if we've got $100 here, let's see here. If we've got $100 here in earnings and somebody wants to pay you $800 for that company, that gives you a price to earnings ratio of 8. Now, these are also referred to as multiples. Are multiples the end all be all? The answer is no. Take, for example, publicly traded companies sometimes have PE ratios in the 40s and 50s because they're very high growth. You see some that have that are publicly traded that have multiples in the 6 range. So on average, when you can start averaging these things, and it's very difficult or dangerous thing to do is to say average, but privates are generally in the 6 to 8 range. Publics are going to get a higher multiple because you have a lot of liquidity. But price to earnings ratio is a pretty prominent multiple metric that is used. So price to sales. So what happens if you have sales of $1 million here, okay, and you're going to get a price to sales of 3. So you're going to value that company at $3 million just because it's 3 times your sales. Why would you do that over earnings? Well, you're going to do that over earnings. What happens if you're in a growth area and you're not making any earnings because you're taking those revenues, you're pushing back into the company. So lots of new startup companies, restaurants that have 10 locations but are going to 30, they can sell that company, but those 20 that are still in process aren't going to be generating a lot of earnings, but they do have the potential to. So price to sales can have a material impact and may make some sense in certain areas when looking at those valuations. Okay, price to book. What is price to book? So price to book is going to be more about the bookkeeping and the assets on the books of the company. So if you have a lot of factories, a lot of plant, a lot of equipment, now you can say, all right, if this company doesn't make another dime, it's still got some value in it because it's got some assets on the books. Now there are some things with price to book that are going to matter. So depreciation is going to matter. So a lot of accounting is going to matter with regards to what is actually your price to book. Is it really a good metric? So something to think out there. So EBITDA, what is EBITDA? Earnings before interest, taxes, depreciation, and amortization. This one is used quite a bit. Why is EBITDA a good valuation metric? Because when you're taking earnings before, so what you're doing when you're getting rid of interest, taxes, depreciation, and amortization, you are getting rid of tax structure. So C corps versus S corps, they're okay. You can start to look at them equally when you look at this type of number. All right, when it comes to comps, what are comps? Comparatives. So let's take privately held companies where we don't have a ready market and compare them to publicly traded companies where there is a ready market. It can give us an idea as to what the market is valuing it today. And in the comp area, you can look at what we've already looked at. You can look at price to sales. You can look at price to earnings. You can look at price to book and say, where does that come from a comp perspective? What is the market saying? So that's another mechanism for valuation. Free cash flow. So what is free cash flow? How much does a company generate in free earnings that don't need to be invested back in the company? How much does it create on a yearly basis? Free cash flow, you're going to have mature companies in protected industries that generally have a really good perspective on what the future is. Not a lot of changes going on in the industry, and you can say how much is this generating with regards to free cash flow, which is similar to discount cash flow. So when you do a discounted cash flow analysis, what you're doing is you're saying how much cash is being generated that I can get, and then how do I value that? So this right here are D over R minus G, which is the dividends over the rate of return we expect on our investment minus our growth rate. That can get us a simplified valuation of the discounted cash flow. It's called the Gordon growth model. That can make some sense there. So that being said, we've covered quite a bit here on a generalized basis. Those are things to think about when it comes to valuations. When people give you multiples and simplified answers and back of the envelope calculations, those are okay to look at from a very, very preliminary step. Then you're going to want to get into the details and say, does this make sense for my company? And what are the issues associated with those particular multiples? That's going to get you the best negotiated settlement with regards to the value that you're looking for. So I want to say thanks for coming. Really appreciate it. Next on our video series, we're going to talk about strategize to maximize, boosting some of your bucks. So this is going to talk a little bit more about the strategy session on how to position your company. So stay tuned for that. For more information, you can check us out here on our website. You can head up to our advisory and our exit and succession planning. Take a look for some of those videos that we've got up there and some more information about our process in the exit planning process. So thanks for listening. We look forward to seeing you soon.